Welcome back to the deep dive. Today we're doing something a little bit dangerous. We're taking the safety scissors away.
We are indeed.
We all love a good rule of thumb, right? I mean,
Mhm.
especially with money. Investing's complicated. The tax code is just a nightmare. So when someone hands you this simple checklist, do this, buy that, save here, it feels like a life raft.
Oh, absolutely. You grab on.
You grab it, you hold on, and you assume you're safe.
It satisfies that urge for simplicity.
Yeah.
If the rule is simple, we just assume it's universal.
But we're looking at a breakdown of an article today titled Debunking Conventional Wisdom, the Strategic Investing Guide. And the central argument here is it's pretty unsettling. It's this idea that these safety rules, the very ones that make us feel so responsible, might actually be traps.
The source calls it the simplicity trap.
Mm-hmm.
The argument is that bad advice doesn't usually look like a scam. It's not some Ponzi scheme.
No.
It looks like common wisdom. And it spreads because it's easy to memorize, not because it's mathematically optimal for your specific life.
And the article makes this distinction that I really want to drill into before we get to this specific rule. It talks about quiet failure. Because if I follow bad advice, I expect to lose money, right?
You expect to crash.
I expect my account to go to zero. But that's not what happens here, is it?
No. And that's what makes it so insidious. If you buy a terrible stock, you know it immediately. It tanks. You learn your lesson. But the strategies we're talking about today, specifically around retirement accounts, they don't crash.
They just fade.
They just underperform. They quietly erode your potential freedom for decades. You don't realize you've made a mistake until you're like 60 years old and suddenly realize your options are incredibly limited.
So you wake up at the finish line and realize you ran the whole race in weighted boots.
That is the perfect analogy. You still finished, but my God, it was harder than it needed to be, and you're not where you could have been.
So let's talk about the weight in the boots. The guide lists several rules to break, but we're focusing on rule number 4 today. And I have to admit, when I first saw this in the notes, I was skeptical. It goes against pretty much every financial blog, every HR orientation.
The uncle of Thanksgiving.
Yes. It's the sacred cow of personal finance.
It is.
The rule they want us to break is just max out your 401k.
It sounds reckless to even say it out loud, doesn't it?
It does. The standard advice is max the 401k, get that tax deduction, set it and forget it. That is the responsible thing to do. So why on earth is this source flagging that as a potential trap?
Well, to be clear, the source isn't saying don't save. It's not saying go buy a boat.
Right.
It's targeting the word just max it out. It's targeting the automation of that decision without looking at the broader strategy. The source argues that for certain people, high earners, business owners, people who want to retire before 65, blindly filling that 401k bucket is actually a massive strategic error.
Okay, let's peel this back. Because the immediate pushback, and I'm sure you're thinking this, is the tax break. If I put $23,000 into my 401k, that's 23 grand I don't pay taxes on this year.
Right.
If I'm in a high bracket, that's real money. Why would I walk away from a guaranteed tax cut?
You're right. It is a guaranteed benefit today.
Yeah.
But you have to ask, at what cost tomorrow? The deep dive highlights 3 major costs of this strategy. And the first one is this tunnel vision problem, or more specifically, missing out on tax planning versus just tax deferral.
Meaning we're just kicking the can down the road.
We are kicking the can, but we might be kicking it into a minefield. See, when you put money in a traditional 401k, you're making a deal with the IRS. You say, don't tax me now, tax me later.
Sure.
But the catch is, when you pull that money out in retirement, every single dime, every penny of it is taxed as ordinary income.
Like a paycheck. Exactly like a paycheck. It doesn't matter if the market went up or down, it's all taxed at your highest marginal rate. Now, compare that to a taxable account, just a standard brokerage account.
Okay.
You pay taxes on the money before you put it in. But the growth, that gets taxed as capital gains.
And capital gains rates are generally much lower than income tax rates.
Significantly lower. For a lot of people, it's 15%. For high earners, 20%. Compare that to an income tax rate that could be 32, 35, maybe even 37%.
So by shielding yourself from taxes now, you're kind of forcing yourself into the high tax bracket later on. But the source mentions specific mechanics here. Things you can do in a taxable account that you flat out cannot do in a 401k. Harvesting was one of them.
Tax loss harvesting, yes. This is a huge tool for wealth building that 401k investors completely miss out on. In a taxable account, let's say you bought tech company A and it tanked. You lost $5,000.
Okay.
You can sell that stock, harvest that loss, and use it to offset gains from another winner, or even offset $3,000 of your ordinary income for the year. So you turn a loss into a tax deduction.
You make lemonade out of lemons in a 401k. That loss is meaningless. You don't get a write-off. The government doesn't care. You just have less money in the account, and you'll still pay ordinary income tax on whatever's left.
Wow.
You lose that strategic lever entirely.
The other term the source used was income smoothing, which it sounds like a moisturizer, but I'm guessing it's about tax brackets.
It's all about control.
Yeah.
Let's say you're retired. You're 65. You want to buy a luxury car, go on a massive world tour. You need $80,000 cash.
Right.
If all your money's in a 401k, you have to withdraw the full $80,000.
Right.
That might bump you from the 12% tax bracket straight up into the 22 or 24% bracket for all your income that year.
Oh, you just spiked your own tax bill.
Massively.
Yeah.
Because you have no choice. The money has to come from that one taxable bucket.
But if you had a taxable brokerage account, the layering approach the source talked about.
Then you could pull, say, $40,000 from the 401k to stay in that low bracket and pull the other $40,000 from your brokerage account.
Which would be taxed at capital gains rates, or maybe it's mostly return of principal, so almost no tax at all.
Precisely. You smooth out the spikes. You can engineer your tax bill.
Yeah.
If you just max out the 401k blindly for 30 years, you arrive at retirement with zero ability to engineer anything. You're completely at the mercy of whatever the tax rates are at that time.
And that's the quiet failure. It's the loss of flexibility. And that leads perfectly to the second big problem the guide identifies. And this one hit home for me, the liquidity trap.
The golden handcuffs.
We all know the rule. You can't touch the 401k money until you're 59 and a half. I mean, you can, but you get hit with that 10% penalty plus the taxes. It's painful.
It's designed to be painful. The government wants you to keep it locked up.
But the source paints a scenario that I think is becoming more and more common. Let's talk about the Dave example, because this isn't just numbers, this is a life path.
Right, the gap year scenario. So you've got Dave. Dave is a diligent saver. He's a high earner, works in tech or law or something. He follows all the rules. He maxes his 401k every single year from age 25 to 45.
So Dave is doing great. He's 45. He looks at his statement and he has, I don't know, $1.5 million in there. He's a millionaire.
He's a millionaire on paper. But here's the twist. Dave is burned out. He's just done. He wants to pivot, maybe start a vineyard, or just take 3 years off to raise his kids, or retire early. He has $1.5 million. He should be free, right?
In theory. But his bank account, his actual checking account is just normal. All the real wealth is locked inside that 401k.
So Dave goes to withdraw money to live on while he starts his new business. He needs, let's say, $100,000 a year.
Okay.
First, the IRS takes their cut, call it 24% for taxes. Then they hit him with a 10% early withdrawal penalty. He's losing a third of his money just to access it.
And psychologically, Dave probably can't bring himself to do that. I mean, seeing that 10% penalty is like setting your money on fire.
So what does Dave do?
He keeps working the job he hates.
He stays in the cubicle until he's 60.
That is tragic. He has the wealth to be free, but the vehicle he chose for that wealth denies him the freedom.
That is the definition of being liquid poor. You have a high net worth, but low options. And the source argues that real wealth is optionality. If you want to start a business at 40, a taxable brokerage account is your best friend.
Right.
You sell those stocks tomorrow, pay the capital gains tax, and wire the money to buy a storefront. No penalties, no permission slips.
It just changes the definition of risk. We usually think the risk is the market crashing, but here the risk is opportunity cost. The risk is seeing the chance of a lifetime and having to say no because your money is in jail until you're a senior citizen.
And that risk is rarely discussed in those HR meetings, is it? Will the savings plan prevent me from pivoting my career in my 40s? Nobody asks that.
Okay, so we've got the tax rigidity, we've got the liquidity jail. Now we have to talk about the third point, which I think this is the most technically complex, but also the most devastating for people trying to build generational wealth. The tax bomb for the heirs.
This is where the math gets really ugly really fast. And it all changed recently with the Secure Act.
Right, the rules of the game just changed.
Yeah. It used to be if you died and left a $2 million IRA or 401k to your daughter, she could stretch that out. She could take tiny little distributions over her entire life, letting the rest grow tax deferred. It was a beautiful wealth transfer tool.
And now?
Gone.
Yeah.
For most non-spouse heirs, your kids, the stretch IRA is dead. The new rule is the 10-year rule. The account has to be emptied, zero balance, within 10 years of your death.
Let's run the numbers on that. You leave $2 million to your daughter.
She have 10 years. So essentially, she has to take out roughly $200,000 every single year for a decade.
And that 200 grand is taxable income.
Correct. And here's the kicker. She's probably in her peak earning years. She might already be making $150,000 from her own job. You stack a mandatory $200,000 distribution on top of that.
Oh, man.
You've just pushed her into the highest possible tax bracket. Federal and state, she might be losing 45, maybe 50% of that inheritance to taxes.
So you spent a lifetime deferring taxes, thinking you were being smart, only to bunch all that income up into a 10-year window for your kids, creating this massive windfall for the IRS.
The source calls it a tax bomb. And the frustrating part is, if that money had been in a taxable brokerage account, the rules are totally different.
Because of the step-up in basis, right?
Exactly. This is the superpower of the taxable account. If you die with stocks in a brokerage account, the cost basis resets to the value on the day you died.
Wow.
So if you bought Apple stock in 1990 for pennies, and it's worth millions now, and you die, your heirs inherit it at the current value. They can sell it the next day and pay zero capital gains tax. Zero. So compare that, a 401k inheritance where the kid pays 50% in taxes versus a brokerage inheritance where they pay zero.
When you lay it out like that, the max out the 401k advice seems almost negligent for people with significant assets.
It's not negligent, it's just incomplete. It focuses on one variable, the current year tax deduction, and it just ignores everything else.
Okay, so we've thoroughly dismantled the simplicity trap. We've scared Dave. We've worried about his daughter's tax bill. But we can't just leave people in the rubble. The source does offer a solution. It's not don't save. It's layering.
Right. We need to reconstruct the strategy. And the source is very clear. There is one time you absolutely 100% feed the 401k.
The match.
The employer match. If your company puts in 50 cents for every dollar you put in, that is an immediate 50% return on your investment. There is no tax maneuvering in the world that can beat a guaranteed 50% ROI.
So step one, contribute exactly enough to get the full match. Not a penny less.
Correct. But then, stop.
Pause the 401k contributions right there.
And look at your other layers. The source suggests filling buckets in a specific order. So match first. Then you look at a Roth IRA if you're eligible, or a backdoor Roth.
Why the Roth?
Tax diversification. You pay taxes now, but it grows tax-free forever. It solves that tax bomb issue because the withdrawals are tax-free for you and for your heirs.
And then after the Roth,
that's when you go to the taxable brokerage account. This is the freedom bucket. This is the money for Dave's Vineyard. This is the money for early retirement. This is the money that gets the step up in basis for the kids.
So the idea isn't to avoid the 401k entirely, but to treat it as just one bucket, and specifically for old age income.
Exactly. Think of your life in phases. The 401k funds age 60 to 90. The taxable account funds age 25 to 60. If you only fund the old age bucket, you are stranding your middle-aged self without any resources.
You're building a bridge that only reaches halfway across the river.
That's a great way to put it. You need the liquidity to get you to the retirement age. The taxable account is that bridge.
This requires a shift in mindset, though, because with the taxable account, you see the taxes come out of your paycheck. It hurts a little bit more today.
It does. You have to accept a little bit of tax drag today, paying taxes on dividends, paying capital gains when you rebalance. In exchange for math and flexibility later, you are buying control.
And that seems to be the theme of this entire deep dive, control versus optimization. The 401k is optimized for a very specific, narrow tax outcome. But the layering strategy, it's optimized for life.
Life is messy. Life is nonlinear. You might get sick. You might get fired. You might get inspired to start a company. A rigid tax avoidance strategy just breaks when life gets messy. A flexible liquid strategy adapts.
It's funny, we started this by talking about how simple advice is dangerous, but this layering solution isn't exactly rocket science either. It's just balanced.
It's balanced complexity. It's acknowledging that you need three types of money. Pre-tax, which is the 401k, tax-free, which is the Roth, and liquid, the brokerage. If you have all three, you can handle almost anything the IRS or life throws at you.
Before we wrap up, I want to go back to that idea of Dave and the golden handcuffs, because I think a lot of people listening might be in that accumulation phase. They're watching the net worth go up, and they feel good.
As they should. Saving is hard work.
But the provocative thought I want to leave everyone with is this. How do you actually define wealth? We usually define it as net worth assets minus liabilities, you know, the number at the bottom of the spreadsheet.
But that number is purely theoretical until you can spend it.
Right. So, is wealth the number? Or is wealth the options the number gives you? Because if you have $2 million locked away until you're 60 and you're miserable at 45, are you actually wealthy?
I would argue you are balance sheet rich and life poor.
Life poor.
If you cannot access your resources to solve your current problems or seize your current opportunities, those resources barely exist. They are a promise for your future self, but you are living in the present.
So maybe the smartest investment isn't the one with the highest tax deduction. Maybe it's the one that gives you the keys to your own handcuffs.
That's the real return on investment. Freedom.
A lot to think about before you set your auto contributions for next year. As always, none of this is specific financial advice for your situation. Go hire a fee-only planner who understands this stuff. But hopefully, it helps you ask better questions.
The quality of your life depends on the quality of your questions.
Thanks for diving in with us. We'll see you next time.
Take care.